What if the most powerful force in America was never fully in the hands of its people? Not the military, not the government, not even the Constitution. Money. In 1913, something changed. Something that would reshape how wealth was created, how crises were handled, and who truly controlled the American economy. It happened quietly, legally, almost invisibly. A new institution was born, one that could create money from nothing, control interest rates, and influence the financial fate of every citizen. It was called the Federal Reserve, and almost no one noticed it happening. Before 1913, America had no central bank. That might sound like freedom. In some ways, it was, but it was also chaos. The country ran on a patchwork system. Thousands of private banks issued their own currencies. There was no single authority to regulate the money supply, no safety net when things went wrong, and things went wrong often. In 1837, a financial panic wiped out banks across the country. Savings vanished. Businesses collapsed. The economy didn't fully recover for years. It happened again in 1873 and again in 1893. Each time, the pattern repeated: speculation, overconfidence, then sudden collapse. Banks would fail. Families would lose everything. And there was no one to stop the bleeding. The American economy was powerful. It was growing faster than almost any nation on earth. But it was fragile. Every few decades, the system cracked. And when it did, ordinary people paid the price. By the early 1900s, something had to give. Then came 1907. It started, as these things often do, with speculation. A small group of investors tried to corner the copper market. When the scheme failed, the banks connected to them began to wobble. Rumors spread. Panic followed. Within days, people were lining up outside banks, desperate to withdraw their money before it disappeared. One by one, institutions began to fall. The stock market dropped nearly 50%. Trust companies collapsed. Even healthy banks couldn't survive the stampede. And then something unprecedented happened. One man, just one, stepped in to stop it. J.P. Morgan, the most powerful private banker in America. He locked the nation's top financiers in his library. Literally locked the doors. And he refused to let them leave until they agreed to pool their money and rescue the failing banks. It worked. Barely. The panic ended. The system survived. But the message was terrifying. America's entire financial system, the savings of millions, had been saved not by the government, not by law, but by the personal decision of one wealthy man. What if he hadn't acted? What if next time there was no one willing or able to step in? A country built on democracy had been held together by emergency meetings and private money. That couldn't happen again. 3 years later, in November 1910, a small group of men boarded a private train in New Jersey. They used first names only. Some used fake ones. They told no one where they were going. Their destination: Jekyll Island, a remote retreat off the coast of Georgia, owned by some of the wealthiest families in America. For 9 days, they met in total secrecy. The group included Senator Nelson Aldrich, one of the most powerful politicians in Washington. Alongside him were representatives of the largest banking institutions in the country, J.P. Morgan's empire, the Rockefeller interests, and others. Their goal was not small. They were designing a new financial system for the United States. Why the secrecy? Because they knew the public would never accept a plan written by bankers. The word central bank was politically toxic. Previous attempts had failed precisely because Americans feared concentrated financial power. So they worked quietly, carefully, and when the plan was finished, they buried its origins. This wasn't a shadowy takeover. These men genuinely believed they were solving a problem. But they also knew the public wouldn't trust them. And so the system was born in silence. 3 years later, on December 23, 1913, President Woodrow Wilson signed the Federal Reserve Act into law. It created something America had never truly had: a central banking system, but it was designed to look different, less threatening. The name itself was carefully chosen. Federal suggested government control. Reserve implied safety and stability. In reality, the Federal Reserve was and is something unusual. It's not fully government-owned. It's not fully private. It exists somewhere in between. At its core, the system works like this: 12 regional reserve banks spread across the country, each partially owned by private member banks. Above them, a board of governors in Washington, appointed by the president. Together, they control the money supply. They set interest rates. They decide how much currency exists in the economy. Think of it like a thermostat for the entire financial system. Too hot? Raise rates, slow things down. Too cold? Lower rates, encourage borrowing. Or think of it like a referee. It doesn't play the game, but it controls the rules. The Federal Reserve could now do what J.P. Morgan had done in 1907, but permanently, legally, and without relying on any single individual. America traded direct control for something else: stability. So why did America accept this? Because the alternative was worse. The panics of the 19th century had proven one thing: an unregulated system could not protect itself. When fear spread, no one could stop it. The Federal Reserve offered a solution, a lender of last resort, a stabilizer, a way to prevent collapses before they destroyed everything. And there were other pressures. Global competition was intensifying. European nations had central banks. America needed to modernize or risk falling behind. The system worked. For decades, it helped smooth economic cycles, respond to crises, and maintain confidence. But it came with trade-offs. Power was concentrated. Decisions about money, about inflation, about who could borrow and at what cost were now made by a small group of appointed officials, influenced by institutions most Americans would never see. Some called it necessary, others called it dangerous. Both had a point. The Federal Reserve has existed for over a century now. It has helped America survive the Great Depression, World War II, the 2008 financial crisis, and a global pandemic. It has also faced criticism, accusations of secrecy, of favoring the powerful, of creating bubbles that eventually burst. The debate has never ended, and maybe it never should. Because the question isn't whether the decision in 1913 was right or wrong. The question is this: do we still understand the power we gave away? And what happens if we forget?